Here's what you need to understand. When a 70% tariff gets announced, markets don't just react, they convulse. And that's exactly what happened in April 2025 when the Trump administration dropped what some analysts are calling the most aggressive trade weapon deployed since Smoot-Hawley crashed the global economy in 1930. But before you think this is just another political flashpoint that will blow over in a news cycle, let me walk you through the actual mechanics of what's unfolding. Because the real story isn't the tariff itself. It's what the tariff revealed about a system that's been teetering on the edge of mathematical impossibility for years. I've been tracking trade flows and currency movements for 2 decades. I've watched the Federal Reserve manipulate interest rates through 3 different administrations. I've seen how the banking cartel coordinates messaging to retail investors while positioning their own books in the opposite direction. And I'm telling you right now, what we're witnessing isn't just a policy shift. It's the moment when decades of accumulated contradictions in the global trade architecture started demanding resolution. Let me set the table properly here. The tariff announcement came on a Tuesday. 70% on specific Chinese goods, targeting semiconductors, rare earth elements, and advanced manufacturing components. The stated justification? National security and intellectual property theft? The actual trigger? That's where things get interesting. 3 weeks before the announcement, a classified Treasury report leaked to certain congressional committees. I've seen excerpts. The report detailed something the mainstream financial press has been actively avoiding. China had quietly divested roughly $340 billion in U.S. Treasury holdings over the previous 8 months, not through dramatic auction announcements, through methodical calculated secondary market sales that were deliberately structured to avoid triggering circuit breakers. Now, the Federal Reserve and Treasury Department publicly dismissed this as routine portfolio rebalancing. Janet Yellen went on record saying it represented no systemic concern. But here's what your financial media won't tell you. That $340 billion represented the single largest coordinated foreign divestment from U.S. sovereign debt since records started being kept in 1974. The pattern becomes clear when you overlay this divestment timeline with Chinese commodity purchases. While dumping treasuries, Beijing was simultaneously stockpiling physical copper, aluminum, lithium, and strategic petroleum reserves at rates that exceeded their domestic consumption projections by 400%. They weren't rebalancing. They were preparing. For what? For exactly what happened next. Here's the crucial part. The 70% tariff wasn't designed to generate revenue. It wasn't even primarily designed to punish China, despite what the press releases claimed. It was designed to force a specific type of capital flow reversal, to make dollar-denominated assets the only viable safe haven when the inevitable Chinese retaliation arrived. And retaliate they did, within 72 hours. But China's response wasn't symmetric. They didn't slap equivalent tariffs on American goods, which is what every economist and think tank predicted. Instead, they announced export restrictions on 7 categories of rare earth elements essential to U.S. defense manufacturing, implemented new licensing requirements that added 90 to 180-day delays on semiconductor shipments, and this is the part that made my jaw drop, they floated their currency by 8% against the dollar in a single trading session. That currency move alone erased $1, $2 trillion in nominal global equity value. Not because it changed the fundamental value of underlying businesses, but because it instantaneously repriced every cross-border derivative contract, every currency hedge, and every multinational supply chain cost structure that had been calibrated to a relatively stable $1 band. What is remarkable about this is how quickly the cascade effects manifested in sectors that appeared completely disconnected from U.S.-China trade. German auto manufacturers saw their stock prices crater by 15% in 2 days. Why? Because their entire electric vehicle production pipeline depends on Chinese battery components and rare earth magnets. Those components just became subject to licensing delays that could extend for quarters, not weeks. Japanese electronics firms faced instant margin compression. Their razor-thin profit models assumed just-in-time delivery of Chinese-manufactured intermediary goods at predictable prices. The tariff and the currency float together created a situation where their cost basis increased by 23%, while their ability to pass those costs to consumers remained constrained by competitive pressure. Then the credit markets started speaking. And when credit markets start speaking, you better listen, because they're telling you what the real money thinks, not what the PR departments want you to believe. Corporate bond spreads for multinational manufacturers widened by 140 basis points in 5 trading days. Investment-grade companies that had been borrowing at 2% suddenly faced 6% for new issuance. That might not sound catastrophic until you run the numbers on a company like Boeing or Caterpillar that needs to roll over $8 to $12 billion in commercial paper every quarter. An extra 140 basis points on that volume translates to hundreds of millions in additional interest expense annually, expense that comes straight out of operating margins that were already compressed. The Federal Reserve faced an impossible choice: raise rates to defend the dollar and support the tariff policy, which would accelerate corporate credit stress and potentially trigger a refinancing crisis, or cut rates to ease credit conditions, which would undermine the entire strategic purpose of the tariff by weakening the dollar and making Chinese exports relatively more competitive despite the tariff burden. They chose a third option: public silence combined with massive liquidity injections through the discount window. Between April 18th and April 30th, Federal Reserve discount window lending increased by $487 billion. That's not a typo. Nearly $500 billion in emergency lending to financial institutions in less than 2 weeks. The Fed reported this in their H41 statistical release, buried in the footnotes, using the passive language they always deploy when they're doing something they don't want scrutinized. Who was borrowing? They won't say, of course. The discount window data gets anonymized to protect financial stability. But we can make educated inferences from subsidiary data points. 3 major European banks, Deutsche Bank, Credit Suisse's successor entity, and Societe Generale, all reported temporary liquidity management operations during this exact window. JP Morgan's derivative book showed unusual positioning in yuan dollar forwards that suggested they were providing emergency currency hedges to clients facing massive exposure. And Goldman Sachs filed an 8K that disclosed they'd taken a $680 million trading loss on commodities and foreign exchange volatility events in late April. Mark my words on this: when Goldman Sachs publicly admits to a loss that large, the actual damage is significantly worse. They're required to disclose material impacts, but they have substantial discretion in how they calculate and present those impacts. A disclosed $680 million loss likely masks billions in client exposure that they're managing through structured products that don't require immediate recognition. Now let's talk about what happened in the Treasury market, because this is where the structural fragility becomes impossible to ignore. The 10-year Treasury yield, which had been trading in a relatively stable 4.1 to 3% range for months, suddenly spiked to 87% in 3 trading sessions. That's a 60 basis point move in 72 hours on the most liquid, most stable sovereign debt instrument in the world. For context, during the 2008 financial crisis, Treasury yields were volatile, but they moved in response to clear credit events: Lehman's collapse, AIG's bailout, TARP passage. Each major yield movement had an identifiable catalyst and followed a logical flight to safety pattern. This was different. This yield spike happened while the dollar was strengthening and while equity markets were selling off. Normally, that combination drives investors into treasuries, pushing yields down, not up. The fact that yields spiked during a risk-off environment tells you something critical. Someone big was selling treasuries aggressively, and the buyers weren't absorbing the volume fast enough to prevent price deterioration. Who was selling? We can triangulate. China was still unwinding positions, though at a slower pace than before. But the real selling pressure was coming from domestic leveraged accounts, hedge funds and prop trading desks that had been running basis trades. These are supposedly low-risk arbitrage positions where you buy treasury futures and short the underlying bonds, capturing the spread between the two. It works beautifully when volatility is low and financing costs are stable. But when volatility explodes and financing costs spike simultaneously, which is exactly what happened, these positions turn into forced liquidations. The accounts have to sell the bonds and buy back the futures to close the position. And they have to do it immediately, regardless of price, because their prime brokers are issuing margin calls that must be satisfied by the end of the trading day. The estimates I have seen from sell-side analysts suggest that 180 billion in leveraged basis trades were unwound during this period. That's an enormous amount of treasury selling hitting the market in compressed time, which explains the yield spike even in a supposed flight to safety environment. The Federal Reserve had to intervene. Again, they announced a temporary enhancement to their standing repo facility, which is just bureaucratic language for we're providing unlimited overnight lending against Treasury collateral to prevent a complete liquidity freeze. This cannot be overstated. We've now reached a point where the Federal Reserve has to actively intervene in the Treasury market, the foundational asset that underpins the entire global financial system. Every time there's a moderate stress event, not once a decade crisis intervention. Routine, recurring intervention to prevent price discovery from revealing the actual fragility of the system. Let me connect some dots that the institutional narrative actively obscures. The U.S. runs a trade deficit of roughly $800 billion annually. That means we import $800 billion more in goods and services than we export. Those dollars leave the country and accumulate in foreign central banks and sovereign wealth funds. Historically, those foreign dollar holders recycled the dollars back into U.S. assets, primarily treasuries, which kept our interest rates low and allowed us to continue deficit spending without facing bond market discipline. This arrangement, sometimes called the dollar recycling system, or more cynically, the exorbitant privilege, has been the foundation of American economic hegemony since Bretton Woods collapsed in 1971. But what happens when the foreign holders decide they don't want to keep accumulating treasuries? What happens when China, Japan, Saudi Arabia, and the European Union collectively decide that holding $7 trillion in U.S. sovereign debt exposes them to unacceptable political and financial risk? You get exactly what we're seeing now. Yields spike because the natural buyers are stepping back. The Federal Reserve has to become the buyer of last resort, which means expanding their balance sheet again after spending 2 years claiming they were going to reduce it. And the entire pretense that U.S. government borrowing is constrained by market discipline evaporates. Here's the crucial part that most analysis misses. The 70% tariff isn't happening in isolation. It's one move in a multi-dimensional chess game being played across trade policy, monetary policy, and geopolitical positioning. The tariff forces global supply chains to reconfigure. Companies that have spent 30 years optimizing for Chinese manufacturing efficiency now have to evaluate alternatives: Vietnam, India, Mexico, or reshoring to the US. Each of those alternatives comes with different cost structures, different political risks, and different currency exposures. While this reconfiguration is happening, the Federal Reserve is managing the dollar's value through interest rate policy and liquidity operations. They need the dollar strong enough to maintain its reserve currency status and attract capital inflows, but not so strong that it makes American exports completely uncompetitive and accelerates the offshoring of remaining manufacturing. Simultaneously, the Treasury Department is managing sanctions policy, which increasingly uses dollar clearing systems as a weapon. Russia got cut off from SWIFT. Chinese banks are facing threats of secondary sanctions if they facilitate certain transactions. This weaponization of the financial system incentivizes the development of alternative payment rails, which is exactly what the BRICS nations are building with their proposed common currency and the expansion of bilateral swap lines that bypass dollar settlement. Every one of these policy tools undermines the others if not precisely calibrated. Aggressive tariffs without monetary accommodation trigger credit crises. Monetary accommodation without fiscal discipline triggers inflation. Financial sanctions without military backing trigger alternative system development. The system worked when America had overwhelming economic and military dominance, and when there was no credible alternative to dollar-based trade. But we're now in a multipolar world where China's economy rivals ours, where European regulatory power constrains American tech platforms, where Middle Eastern energy producers have multiple buyers, and where digital technology enables payment systems that don't require New York clearing banks. And the 70% tariff revealed all of these contradictions simultaneously. It was the stress test nobody wanted to run because once you run it, you can't unsee the results. Let me walk you through what happened in specific sectors, because the aggregate numbers mask crucial details. Agricultural commodities faced immediate chaos. American farmers depend on Chinese purchases of soybeans, pork, and wheat. Those markets evaporated within days of retaliation. Soybean futures dropped 22% in a week. Farmers who had already planted their spring crops based on price projections from March suddenly faced potential losses that would exceed their operating capital. The Department of Agriculture announced an emergency subsidy program, $28 billion to support affected farmers. But here's the thing about agricultural subsidies. They're politically essential, but economically distortive. You're paying farmers to produce crops that don't have market buyers at prices that don't reflect supply and demand. That's fine for one season, maybe two. But if this trade conflict extends into multiple planting cycles, you're fundamentally breaking the price signal mechanism that's supposed to allocate agricultural resources efficiently. Technology supply chains face different but equally severe disruptions. Apple's entire iPhone production ecosystem depends on Chinese manufacturing and assembly. The tariff didn't directly hit finished iPhones, but it hit the component suppliers, the companies making the OLED screens, the haptic motors, the precision aluminum casings. Apple's response was telling. They didn't immediately announce price increases or production cuts. Instead, they quietly accelerated their India manufacturing partnerships and began negotiating with Vietnamese assembly facilities. But here's what the press releases don't mention. Transitioning that kind of precision manufacturing takes years, not months. You need trained workers, quality control systems, supplier networks, and logistics infrastructure. Vietnam doesn't have that at scale yet, neither does India. So what actually happens in the interim? Apple maintains production in China and eats the margin compression, hoping the tariff situation resolves before their next product cycle. Or they pass costs to consumers and risk demand destruction in an already saturated smartphone market. Neither option is good, which is why Apple's stock dropped 18% in the 2 weeks following the tariff announcement, despite no change in their fundamental revenue or earnings. The energy sector showed perhaps the most interesting dynamics. Chinese demand for American liquefied natural gas had been growing steadily, representing a rare bright spot in the trade balance. The tariff didn't directly target energy, but China's retaliation included suspending new LNG purchase contracts and allowing existing contracts to expire without renewal. American LNG export terminals, representing tens of billions in infrastructure investment, suddenly faced demand uncertainty. Cheniere Energy, the largest U.S. LNG exporter, saw their forward contract book deteriorate by 30% in notional value. Their stock price followed, dropping 24% as analysts recalculated revenue projections based on the new geopolitical reality. But here's where it gets interesting, that LNG has to go somewhere. Global demand for natural gas hasn't changed. So American exporters started aggressively marketing to European and Asian buyers outside China, which means Europe, which had been reducing its reliance on Russian gas by buying both Russian LNG and American LNG, now had increased negotiating leverage. They could play American producers against Middle Eastern suppliers to get better pricing. The result? American energy producers face margin compression even without being directly targeted by tariffs. The entire global pricing structure for LNG shifts downward because Chinese demand, which had been the marginal price setter, disappears from the market. What's remarkable about this is how quickly financial contagion spread through correlation channels nobody was actively monitoring. Municipal bonds started trading erratically. Why would tariffs on Chinese goods affect municipal bonds issued by American cities? Because several major cities, particularly those with ports handling Chinese imports, derive significant revenue from port fees, logistics employment, and related commercial activity. Long Beach, California, Seattle, Washington, Savannah, Georgia. These cities' credit profiles immediately became more questionable as analysts started modeling reduced import volumes and the corresponding tax revenue impacts. Pension funds holding those municipal bonds had to mark positions to market, which created paper losses that affected their funding ratios. Several major state pension systems, Illinois, New Jersey, Kentucky, were already underfunded before this happened. Now they're facing additional pressure from asset depreciation in what's supposed to be the safest portion of their fixed income allocation. Commercial real estate hit another rough patch. The sector was already struggling with the post-COVID structural shift toward remote work reducing office demand. Now add supply chain uncertainty affecting construction costs, interest rate volatility affecting financing costs, and economic uncertainty affecting tenant demand. The commercial mortgage-backed securities market, which packages these loans and sells them to investors, started showing serious strain. Delinquency rates on retail and office properties climbed to levels not seen since 2012. And the banks holding these loans on their balance sheets started having uncomfortable conversations with regulators about their capital adequacy. This is the cascade effect. The tariff triggers trade disruption. Trade disruption triggers credit market stress. Credit stress triggers forced selling. Forced selling triggers price deterioration. Price deterioration triggers margin calls. Margin calls trigger more forced selling. And the cycle accelerates until someone with infinite balance sheet capacity, meaning the Federal Reserve, steps in to break the chain. The implications are clear. We've built a global economic system so tightly coupled, so heavily leveraged, and so dependent on perpetual liquidity injections that any significant policy shift triggers systemic stress. The 70% tariff didn't break the system by itself. It revealed that the system was already broken, held together by central bank interventions, by accounting conventions that mask insolvency, by political agreements that paper over fundamental contradictions. Now here's what happens next, and why you need to be paying attention to the details rather than the headlines. The immediate crisis gets managed. The Federal Reserve provides liquidity, the Treasury Department provides subsidies, and the political apparatus negotiates some face-saving partial rollback of the most extreme measures. Markets stabilize, yields come back down, and the financial press declares that cooler heads prevailed. But the underlying dynamics don't reverse. China doesn't suddenly resume buying treasuries at previous levels. Supply chains don't unreconfigure. Companies don't abandon their diversification strategies. The knowledge that the system can be weaponized this aggressively doesn't get forgotten. So we enter a new equilibrium, one characterized by higher geopolitical risk premiums, lower efficiency in global supply chains, and greater reliance on monetary policy to smooth over structural problems that should be addressed through fiscal and trade policy reform. For investors, this means several things. Traditional diversification strategies based on historical correlations don't work the same way when policy shocks can trigger simultaneous selling across supposedly uncorrelated assets. The 60/40 stock-bond portfolio assumed that bonds would rally when stocks sold off, providing ballast. But when credit stress drives both stocks and bonds lower, as happened during this tariff shock, that protection evaporates. Volatility becomes structural rather than episodic. Options, pricing models that assume mean reversion and normally distributed returns, underestimate tail risk, which means hedging becomes more expensive exactly when it's most needed. Currency risk, which American investors have historically ignored because the dollar's reserve status made it someone else's problem, now requires active management. A portfolio heavy in multinational companies faces embedded currency exposure that can overwhelm fundamental business performance when exchange rates move violently. And perhaps most importantly, policy risk, the risk that government decisions will materially impact asset values, is now the dominant factor in portfolio construction. It doesn't matter how good a company's management is or how innovative their products are if tariffs,